So your business now makes consistent profit. Congratulations. And be careful, because this is the exact moment most owners actually take their most important questions to the wrong person and then pay for the answer twice. So stay with me. In the last video, I gave you a marker: consistent profits at scale with surplus the business does not need. If that's you, much respect. Most actually never get there. But at this stage, the strategy that gets you here actually starts working against you. Profit first was the whole answer while you were building. Now, the surplus that you have is stacking. The complexity has grown past the setup you built years ago. Now, every year you run the new business on the old picture, the eventual bill quietly compounds. The order didn't change, you just reached step 2. And in video 1, I made you a promise to show you where your money is actually going, and this video is going to keep it. I'm Henry Wong, a CPA CA with 20 years in senior finance. PwC, Rogers, one of Canada's most iconic family-controlled companies, with over 1,000 advisory engagements, as well as over 10,000 CPAs personally trained across Canada. And those engagements never lived in one narrow niche. They involved different business models, different industries, as well as different scales, from the owner running a single location to the largest family enterprises in the country. Here's the part of my resume that actually matters to you. I've sat on both sides of the table, outside as the advisor, as well as on the inside in the seats where decisions were made, decisions had consequences, and where the call was mine and the outcome landed on me. I'm also an entrepreneur as well, with my own lessons and my own battle scars, which taught me something most advice never actually admits. Knowing the rule book is the easy part. Living with the decisions is the hardest part, and it is always harder to manage than the advice actually makes it sound. So hear everything from this video from that vantage point. Being compliant matters. It is the floor, and I will defend it all night. But an expert whose only goal is the safety of that floor can only ever hand you generic advice. It's never tailored to your situation, never priced in the weight of your seat. That is not what I'm here to be. I'm here the way a partner shows up, who, knowing the rule book deeply, as well as knowing the seat, because I have as well sat in them. I bring the tax skill sets, the structures, the reorganizations. I built those along the way, especially prior to 2018, before the new tax code rules started to get rolled out. What I am is a wealth structurist, implementing the 7 structures of wealth for family enterprises and business owners serious about building generational wealth. And I wrote the book on what I learned, the 7 structures of wealth, because what I saw at that level, how real fortunes are built, protected, and passed on, almost nobody talks about it publicly. And the standing guardrail. This channel is education, it's not advice, and every situation is different. Nothing tonight is a rule. It is a guardrail, so you never go off the cliff without knowing it was coming, so you can just peer over it. That's how you learn. So, what does the upgrade involve? 3 words your feed throws around without ever explaining to you. Structure, architecture deciding where your profits live, how your surplus is protected, and what happens at the big events. There's reorganization, the renovation, moving a business that outgrew its setup into an architecture that fits what it became. And then lastly, the timing, the one that matters most, because our tax system is progressive, and a progressive system taxes concentration. The most concentrated event of your financial life is the one nobody schedules. It's the sale, the succession, the transfer, as well as the day a life ends. Unstructured, that event can claim more than half of your life's work. Not because anyone rated you, because no one measured when. And unread terms always resolve to the defaults. And the defaults were not written with your family in mind. Now, when I say progressive, most owners just nod. Everyone knows the line: the more you make, the more they take. And the nod is actually the problem, because you have gone numb to it. And numb feels the same as being informed. Knowing the system is progressive and stopping there is standing at the harbor saying, yes, the water is wet, there's an ocean, and look, I even have a map. All of that is true. However, none of it sails the boat, because the weather changes, the rules move, and safe water that was there 2 years ago has rocks in it today. Because a map is not the skill of handling a storm. When the concentrated year arrives, the map doesn't do the steering. And because knowing the ocean exists was never the same as a guide who has actually crossed it. Progressive is the weather your business sails in every year, and it connects in ways the nod never reaches. When you take income, in what form, from which company, in which year, against which event. The owners who lose are rarely the ones who did not know the water was wet. They knew, they nodded, and they still sailed anyway with nobody at the helm. So there's two doors owners lose at because they are opposite doors and you should actually know both of them. Door number one is too early. Complexity purchased before value existed, cost and rigidity that was subtracted from capital that should have been compounding for you. That was the whole lesson of video one. And if you are here, you likely avoided it, or you learned it and just got here anyway. And door two is yours to watch, which is quite late. The structure built years ago hasn't been revisited. While the business grew past it, the rules moved under it. Too early buys complexity without value, too late holds value without protection. And the when between them is measured. It's actually not guessed. You measure the gap between what you have built and what a concentrated event would claim. You measure how fast that gap is compounding. And when it compounds faster than you are comfortable ignoring, that is when structure earns its cost. And there's a third way owners lose, and it's not an event, it's actually a loop. And you may be standing inside of it right now, and here's how the system is built. Your corporation earns active profit at the low corporate rate. In Ontario today, about 12.2%. The moment you take money out, you and your family, the personal side, takes its share between 30 to 50%, depending on bracket and form. The system even has a name for how the layers are meant to work. They call it integration, for them actually. It's designed so that when it's understood and steered, earning it through the company as well as earning it directly in your personal hands, they all land in roughly the same place. But without the right education, here's what happens. The personal gate actually looks very tall. So you do the thing that feels smart. You minimize what you are taking out of your company. Now, the money is actually now building up inside your company. It's inactive, it's parked, so it's earning passive income. And you know what the code does to passive income? I've already shared with you before, it takes roughly half of it. In trying to avoid one gate, you actually walked into the other. So you shot yourself in the foot with the safety on. So here's why I call it a trap, and it's not a mistake. A mistake happens once. This one feeds itself. Every year your surplus grows, your passive bill grows with it. The exit looks more expensive than it did last year, and the instinct to leave it all gets actually stronger, round and round. So that is what I call the pattern loop trap. And unless you have the right strategist beside you, the kind of judgment that only comes from experience, and so you stay inside of that loop for years, and you probably don't even know that you are inside of that loop, even knowing you are standing inside of it. So the loop does not feel like it's losing, it feels like being careful. And this is what makes it the most expensive feeling in Canadian business. So what breaks the loop? It's not a formula. The way out is a number. How much comes out, in what form, in which year, and how whatever stays in gets put to work instead of parked. And here's this part precisely, because it is the whole point. That number is actually individualized. It is unique to you, your family's needs, your spending, the stage you are at, and your other income, your other plans, goals, objectives, your desires, as well, most importantly, your event horizon. It's not a template and it's not a formula somebody just easily calculates and then hands to you. That doesn't apply directly to your situation. So the moment someone hands you the same number they handed their last client, you are not looking at structure, you are not looking at architecting. You are looking at a recipe, and you already know from this series what recipes are worth. So here's an honest question for you. The setup you are running today, was it designed for the business you have now, or the business you had when you signed that paperwork? Keep that answer. It decides how urgent the rest of this video is. So what did this section give you? The vocabulary, the measurement, and the loop. You know what structure, reorganization, and timing actually mean. You know the when is a measured gap, not a feeling, and you can now see the trap that dresses up as carefulness, minimizing the draw, parking the surplus, and feeding the penalty on a loop. Breaking it starts with an individualized number, never a template. which raises the real question of this stage. Who do you trust to measure it? And here's where almost everyone, including sharp operators, walks straight into the trap. In video 1, I gave you the self-audit. You pull your T2 and find the scoreboard. Now I walk the filing with you because this document is not just paperwork. Read correctly, it is a map where your money actually went last year. So there's 4 stops to it. Stop number 1, what your company earned, and more importantly, what character it wore. The filing splits your money into 2 kinds. Active business income on the cheap road, and then there's investment income, which is the penalty road. Your financial statements prepared under GAAP never make that split. The T2 has to though. So the first page of the map answers the first question. Which road did your dollars travel? Stop number 2, what you actually paid on each road separately. Not a blended number, the low toll on the active side, and then the heavy toll on the parked side. Each one of those are visible. Most owners just have never once seen their money split this way, and that is exactly why the parking penalty can run for years without a single alarm going off. Stop number 3, what is stacking up? The balances that carry forward year over year, tracking the extra tax you paid on parked income. Now, some of it is refundable when the right steps happen in the right order. That stack is the loop from earlier tonight, when it's measured in dollars on a government document with your signature on it. Stop number 4, what left the company and in what form. That's the draw. Every dollar that came out chose a door. Every dollar has a different piece. And this page shows which doors you have been using. Put the 4 stops together and you are holding the money map. What came in, what character it wore, what each road costs, what is stacking, and what went out through which door. That is what where is my money actually going looks like when it is actually answered properly. And your financial statements were never built to answer those questions. It's not a flaw in the financial statements. It's actually a flaw in what you were told they could do. So in this video, you gained the map and the reading. 4 stops, 1 filing, and for the first time, your own loop in your own numbers, which raises the question that decides everything downstream. Who in your corner can actually walk this map with you? And that brings us to the trap. Here is the trap. Most owners take business questions to their tax professional and tax questions from their business feed. Both of those are backwards. Let me be fair, because fairness is how this channel works. Your CPA in tax compliance is likely good at exactly what you hired them for. Filing it correctly, keeping you compliant, recording the past. Those are real skills and it matters. But understand the scope of the engagement. They are paid to report the history. They are not paid and not staffed and usually not trained to design your future. So growth, pricing, whether to restructure is never in the engagement letter that you receive. So when you ask the person who files your return whether it is time to reorganize, you are asking the right person the wrong question. And when they answer anyway, because clients push, you get cautious, generic answers dressed up as strategy, not because they failed you, because you assigned them a job they were never hired to do. And it cuts the other way too. When your business advice comes from tax content, you get the opposite failure. Aggressive, generic answers dressed up as strategy from someone who has never seen your file. So write this down as the lane rule. Compliance professionals record the past, advisors design the future. Content does neither of them. Content sells. 3 different jobs, the expensive mistakes at your stage happen when you let one of them moonlight as another. And if you want to see why the lanes are real and it's not just my opinion, that is one of the things my full demonstration proves on screen on how to vet your tax practitioner, as well as to get some perspective of how complex the Income Tax Act is. In it, I measure the honest size of any specialties domain inside the income tax itself, live with the act doing the counting. The executive summary for you is every professional's world is a region of the code, not the whole code. Small is not an insult because specialists are supposed to be small and deep. The problem for you to be careful on is when one region walks into your life introducing itself as the whole picture. You'll see exactly what I mean when you watch it. So what can you do with the lane rule tonight? Sort your advisors into lanes. Who records your past? Who actually designs your future? For most owners at your stage, the second lane is empty, and it has been empty this whole time. That vacancy, not your tax bill, is the most expensive line in your picture, and filling it correctly requires knowing how to evaluate the person who wants that seat, which is exactly what video 3 will teach you. So here's your assignment in order. First, walk the 4 stops on your own, T2, and write down what you find. The map only works when it is your map. Second, sort your lanes. Who records, who designs, and is the design seat empty? Third, watch video 3 because before anyone touches your structure, you need to tell a practitioner from a performer. At your net worth, the recipe industry now considers you its favorite audience. You will see business owners with too much taxes to pay. That's an example. Video 3 hands you the evaluation standard that I use. And the 4 questions recipes cannot survive. And the full demonstration is linked below. The whole Income Tax Act on one screen live. You do not need to know the whole Income Tax Act. You just need to know what it reads for you so you can make the decision whether the person who's going to occupy that seat, who's going to manage your biggest expense in your lifetime, is qualified for that journey with you. Watch it as a benchmark for everyone already in your corner. So for the comments, who is currently in your design seat? Not the one who files, who designs? If the honest answer is nobody, that's actually quite normal. But what you can do is type some additional questions in the comments. And if there's something that I didn't answer in this video, I'd love to be able to answer them. So here's one line to carry out. The villain at this stage is not your CPA in tax compliance. It is also not the tax system. It is actually the empty seat, and every year it is sitting empty. The default is writing your plan for you. I'm Henry Wong, the Wealth Structurist, and this channel is all about education, not advice. Every situation is different, and remember, no one cares about your wealth more than you do. Education closes the gap, and the gap is the difference between you keeping your wealth or you losing it.